Welcome to the Pitcher Partners Federal Budget Briefing for 2026 to 2027. My name is Jake Berger and I'm a partner in the Private Business and Family Advisory Division and also in the tax advisory space here at Pitcher Partners in Sydney. As trusted advisors who believe in making business personal, we provide advice to high wealth individuals, small to medium public companies, large proprietary companies, local government and privately owned businesses. Today, we want to break down for you this year's federal budget and its impact on you and on Australian businesses. And I'm sure you will all agree it is a cracker. For those of you who this is your first time at a Pitcher Partners budget webinar, just so you know, I've done this presentation for the last 4 years and I passed on it this year, and I must admit I am jealous of Ankit and Cameron who get to do it this year because there is so much content after multiple boring years. Not to worry though, so our team have done the legwork and will examine the tax industry and economic implications of this year's federal budget. This will allow you to make informed decisions and to understand what the drivers will be going forward so that your business can remain competitive and thrive. So joining me today is Ankit Sharma and Cameron Curko. So Ankit, one of my partners, is a long-standing member of the Pitcher Partners family. He takes a holistic approach to delivering on clients' needs, balancing technical expertise, simplicity, and commerciality. With a client portfolio that includes executives, investors, professional services partners, high net worth groups and family offices, Ankit has the expertise to navigate diverse financial requirements, including assisting clients with both their operating businesses and their personal investments. Cameron is our Chief Investment Officer. In this role, he helps guide the strategic asset allocation of the firm and manages model portfolios across a range of assets, including direct equities, managed funds, and ETFs at the behest of the Wealth Investment Committee. He also plays an important research role in assessing alternative and fixed income investment offerings for our wholesale investor client base. So before we get started today, some webinar housekeeping logistics for you. We have got a full house, plenty of people on, which is great. So in the interest of quality internet experience, please keep your screens and microphones off. We'll be holding a Q&A at the end of the speakers' presentations, so please use the chat and Q&A function to type in your questions. We'll be sure to answer as many of those at the end of the presentation. This webinar will be recorded and a copy of the recording and the slides will be made available for you in approximately 3 days. And this webinar will no doubt raise many questions for you about your own circumstances. So please feel free to call us or drop us an email to discuss further. Without any further ado, let's kick off. Over to you, Ankit.
Thanks very much, Jake. And yeah, there is a lot to this particular federal budget. So what are we going to be covering today? So a little bit of context. Individuals and business measures. We're also going to then talk about probably the big three, as I call it, capital gains tax, trusts, and I guess the negative gearing piece, as well as several other measures. Mindful of time, so I will probably push through these quite quickly, but there's a little bit of extra detail within the slides themselves. I'm just noting there should have been a standard disclaimer slide. I'm not seeing that as we stand, but hopefully that will be with the final pack. And naturally, as it usually states, please don't take this advice as advice. The measures are all of 30 hours old, and there's a lot to unpack. So naturally, we've got to consider each of your individual circumstances as part of that unpacking process, which this webinar by no means is able to do. So this particular budget is a fundamental shift to tax strategy. The investment tax settings have been rewritten and negative gearing has been curtailed. The capital gains discount has been replaced by indexation, and trust distributions now have a minimum 30% tax rate applied. There's also a series of niche tweaks, particularly in the R&D as well as the early stage venture capital limited partnership space. I think a thought bubble these changes will likely alter investment behaviour and structuring decisions going forward. There is also a significant compliance burden with many of these measures, and ultimately the devil will be in the detail, as it usually is. Before I launch into what was in the budget, I think we've got to step back a bit. There's been some big changes, but things to keep in mind. The federal budget is a list of revenue raising and spending measures. No draft legislation is currently available. This is purely just high level details only and not law as we stand. Based on the government announcements on the budget night, we've sort of pulled together these slides. And one thing to sort of keep in mind is there's a significant number of announced but unenacted measures from FRI budgets, such as FBT, Division 7A reforms, corporate and individual residency. And I think a key case in point, which I'll speak about in a couple of slides' time, is Division 296, which is the additional 15% tax on earnings for members with more than $3 million in super. That was actually announced in the 2023-24 budget, but it's only about to sort of commence from 1st of July 26 onwards. And there were actually 2 rounds of legislation, multiple rounds of, I guess, consultation with industry. Just going off the Pitcher Partners website, which there's a QR code there, the budget signals a more complex business and investing environment with a requirement for businesses to prioritise restructuring over growth due to the new rules. So I think that's kind of just a thought bubble for you. We're in this sort of position now where I'm calling it a strategy vacuum. So it's a question of what to do. Most of these changes come into force from 1st of July 27 and 1st of July 28, and we'll sort of step through each of those changes and the associated timings. The government is looking at providing restructure relief, but the question as to whom and how is yet to be seen. When you look at is this likely to pass through Parliament? The House of Representatives, the government has a majority, but the Senate, there may be some concessions required, particularly to the Greens and the crossbenchers and the independents. Special interest groups will also have their say. So I think the bottom line is these changes are significant, but there is time to consider the right strategy. When it comes to individuals, there's the announcement of the $1,000 standard deduction from 1st of July 2026. That's actually not a new measure. That was announced in the previous budget, but has been reaffirmed and confirmed. That's basically a substantiation simplification for individuals. The $250 tax offset is for people with employment income and or as sole traders, and that will be automatically noted on tax returns from 1st of July 2027. Previously announced tax cuts have been confirmed. So the $18,000 to $45,000 tax band is reducing from 16% as we stand to 15% to 14% by the 28 financial year. The Medicare levy thresholds have increased by about 2.9%, and private health insurance rebates have been reduced for over 65s to sort of simplify some of that. There was a distinct lack of, I guess, announcements in relation to superannuation. In one sense, that's sort of a good thing because there's a significant amount of announcements. But what I did was reach out to Minnie, who's our client director in the private business and family advisory space that focuses on super. And I think that there's a very valid point in the quote that you see up on screen. Division 296, which I've briefly spoken about, as well as payday super, will both commence 1st of July 26. There's nothing in the budget around that, and they're very topical and live discussions with our clients at the moment. Division 296, we've been sort of doing modelling, particularly for those that currently have 3 million, but there's potential for more and more taxpayers to fall into that net over time. But some of the broad modelling assumptions may change, particularly as a result of the capital gains tax and the 30% minimum tax on discretionary trusts. So from a business perspective, there wasn't a huge amount in the budget, but what we are sort of thankful for, and we'll take our wins, is the $20,000 instant asset write-off, which has been permanently extended. In the past, that has been a Each year we have to wait and see what Parliament passes, what the rate is and what the threshold is, but that is we'll take that as a small win. The loss carryback rules will be reintroduced, and that's where, as an example, profit is made in this financial year. The last 2 years losses were made. It's the ability to sort of claw back some of those losses and get cash in pocket. So I think that's a positive. Venture capital caps have increased, the R&D tax incentives to be overhauled, but we're now talking a couple of years into the future, and the loss refundability for startups is a new provision. Particularly on the venture capital changes, I reached out to Dragan, who's our private equity and venture capital industry lead, and I think there's a positive in the changes for the industry. The government is looking to try and continue, I guess, building and sort of garnering investment in the early stage company space, as well as potentially private equity, and the R&D changes sort of help that. However, when you look at the founders and investors in these funds and the companies themselves, the capital gains discount plays a large role in the after-tax, I guess, returns from that particular investment class. Similarly, Craig Jack, who's our R&D client director, sort of by and large, the R&D tax incentive changes, granted they are from 1 July 2028, are a positive. They're increasing the tax offset rate, expanding turnover thresholds, but they're capping there's a 10-year limit now on refundable offsets. There's certain exclusions and sort of smaller claims are potentially going to fall out of the system. Onto the first of the big three. So negative gearing. Residential properties are the only asset class that are impacted by this, and it's quite possible that I guess the definition of residential property could be slightly broader than what most people think. Existing properties can continue to be negatively geared until sold. Properties acquired between budget night, being 12th of May, and 1st of July 27 will come under the new rules, but those particular properties can continue negative gearing until 1st of July 2027. Just for the abundance of clarity, in this particular context, negative gearing is where the expenses of the property exceed the income of the property, and therefore there's effectively a tax deduction to be had against other income, particularly in the individual's name, but this can also correspondingly apply to partnerships, companies, and trusts. So from 1st of July 2027, there's a limit to negative gearing only for new residential builds, and any existing sort of property stock that's been purchased from 1 July 2027 will have the losses quarantined. The losses will be deductible against other property profits or potentially against capital gains as well. Any excess losses will be carried forward. A couple of exceptions to this. Widely held trusts, superannuation funds, certain build to rent have been specifically excluded in the budget documents to date. The one thing that's not clear in my mind is if this is a property by property or all residential properties are going to be pulled together. So this is a space to be watched, but then coupled with the capital gains tax changes, that probably changes the view on particularly residential property, and I think it will change the landscape a bit in that space. So what's happening with the capital gains discount? The 50% capital gains discount will be abolished from 1st of July 2027, and it will be replaced with an index-adjusted indexation. This will apply to individuals, trusts, and partnerships. You will note companies this change does not apply to, but companies never receive the capital gains discount to begin with. It will apply to assets held for greater than 12 months, and probably the big provision that does require a bit of planning is pre-1985 assets. So those that were grandfathered are now being brought into the indexation net. My understanding is that there's a valuation at 1st of July 27 that sort of creates the cost base and then any future gains from that point onwards, but we will need to see what the actual legislation says on that account. In addition to indexation, there's a minimum capital gains tax rate of 30% being applied to capital gains. Pensioners and those that receive government benefits are excluded, but there's actually no detail on how, what, and the like, how that will be administered. New residential properties can choose to claim the capital gains discount, or alternatively, they can choose to have the indexation and the minimum CGT tax rate applied. At this stage, we're not certain as to is that a choice when you purchase the property, is that a choice when you sell, or somewhere in between. What all this means is an added layer of complexity. There's taxation of gains after 1 July 2027 will be split between discount for those assets purchased prior to 1 July 27 and indexation for assets that are held after that date. And we've got a slide on that to explain that in a little bit more detail. So indexation versus discount capital gains. Indexation itself is not necessarily all bad. I guess on the slide here, it's sort of looking at the various settings, I guess, for particular investments and the economy as a whole. So in a high inflation environment, indexation is a positive. In a low inflation, discount is. Asset growth, which equals indexation. Indexation generally provides a better result. Assets for yield, not growth. Indexation versus high growth, such as private equity and venture capital. The discount is ahead. Short term, discount generally is a positive. Long term, indexation is. So I think you've got to keep in mind indexation was in place between 1985, when the capital gains tax regime was first announced, to 1999, and then after 1999 the discount regime came into place. At this stage, we haven't heard anything on non-resident treatments. We've got two relatively simple high-level examples. Won't run through these in a huge amount of detail, but one is a significant growth scenario where it's clear in this context that indexation will result in significantly more tax. I think the one thing that also jumps out at me is capital gains discount applies to the whole gain versus indexation applies to the share cost base only. And that sort of is a mechanical consideration, but probably a bigger thing, particularly for the advisors and the clients on this call, is projections of capital gains tax positions I expect will become more complicated depending on timing and growth projections and indexation projections. So that was a high growth scenario. In the low growth scenario, and low and high in this case are relative, but for illustration purposes, in this case, the indexation actually provides a lower tax cost, i.e. a higher after-tax sort of return. A reminder, these slides don't consider the minimum 30% tax on capital gains. So capital gains tax, transition and practical operation. We've already sort of been through the dates, but just to reiterate, pre-1 July 2027, gains are taxed under discount. Post-1 July 27, gains are taxed under indexation. Gains are split across pre and post regimes for existing assets, and the two mechanisms Treasury has provided is one, to obtain a valuation at 1 July 2027 for listed assets. This is relatively straightforward. For unlisted assets, I imagine valuers will be in high demand. The ATO will also provide a tool to estimate the value for taxpayers, but at this stage, we don't have any detail on what that tool looks like. Is it a proportional method or is it some other method? Ultimately, my expectation is that most clients would want to seek both just to maximize flexibility and compute as transactions occur. Something to keep in mind, assets sold prior to 1 July 2027 will have the full capital gains discount apply. And at this stage, there's no change to the small business CGT concessions that we can see. We've got a calculation here on screen, which I'll let you sort of review in your own time, but really this is looking at an asset that's been held for 10 years. It's had sort of growth over that period. It straddles the discount versus indexation period. And under the old rules, high level, it's $188,000 tax payable at the 47% tax rate. under the new rules, it's about 228,000. So in this particular scenario, the tax impost of those capital gains is higher, but that's not always going to be the case. The third of the major changes, so 3 out of 3, is discretionary trusts. So a minimum 30% withholding tax has been announced from 1st of July 2028. One of my fellow partners did sort of point out that might get us relatively close to the next election, so space to be watched. What does this all mean? So the trustee, so a discretionary trust makes profits. Those profits need to be distributed out to a beneficiary, otherwise the top tax rate will apply. In this case, the trustee will pay 30% tax, and that will then flow through to the individual and or a non-corporate beneficiary for them to apply against the tax that they would need to pay. There's sort of an announcement in there as well. The trustees must use franking credits to meet the minimum tax. Corporate beneficiaries will not receive the benefit of the tax. And kind of, I think broad brushstrokes, when you look at it, the negative impact is for beneficiaries with a lower tax rate or tax rate of 30% or less. So when you look at some of the modelling that's sort of out there, as an example, if an individual has more than $45,000 of, say, salary income, the actual marginal tax rate that they're paying is 30%, therefore there should be no impact. But if that same taxpayer and beneficiary of the trust had nil taxable income, then the 30% rate would apply, and that would be higher than what they're currently paying. There's sort of, I guess, a question mark over where there's a chain of trusts and there's trust losses and how this all kind of interacts. And there's also an elephant in the room around our discretionary trusts on death row. I think they still definitely have a place from a asset protection, estate planning, and otherwise sort of position. But I guess, again, the devil is in the detail in the legislation as to will these reforms be exactly as announced, or will there be tweaks? So I've sort of used the term discretionary trusts. For abundance of clarity, these rules do not apply to fixed trusts, superannuation funds, charities, special disability trusts, or deceased estates. There are also certain income classes that are excluded. So primary production income, where withholding taxes already apply, such as discretionary trusts distributing to non-resident beneficiaries, as well as income from discretionary testamentary trusts which exist at budget night. We've got a bit of a sort of a scenario here where I'll run through this quickly again in the interest of time, but a trust makes business income of $100, withholding tax of $30 is applied, tax paid, distribution paid to the trust, the company being the corporate beneficiary is $70. Company will then pay tax at 30%. And ultimately, if that company is owned by an individual, dividend gets declared. And this might be over the course of a couple of years, not generally back to back. The individual will then have $70 of income, pay their marginal rate, get the offset for the franking credit, and they also have a bit of further tax to pay. So this is sort of how the industry reads it, but there is a certain level of, question marks and lack of clarity as to, is this what the government intended? So on this, the actual effective tax rate is 62.9%. So as announced, corporate beneficiaries may not be as valuable as they used to be, but again, space to be watched. And I think this is a very pertinent conversation, particularly as we get into 30th of June 26 planning for those that have the trust structure and the corporate beneficiary in place. So the trusts, the government has acknowledged that there's a significant number of trusts out there, close to 1 million of them. A number of them will operate businesses. So there is going to be rollover relief for the next 3 years from 1 July 2027 onwards. There's also going to be supporting measures to support restructures out of discretionary trusts. And the government seems to suggest, hey, maybe think about companies and fixed trusts. At the moment, there is no detail on these measures, but one caution is around the stamp duty and landholder duty risks and whether the state governments will sort of come to the table and provide particularly exemptions around those sort of restructures. From an administrative and system integrity provision, there was a few sort of announcements there, probably broadly small ticket items, but worth sort of flagging as part of these conversations. There'll be additional ATO funding for fraud and compliance, which is sort of a common theme throughout the last couple of budgets. There's an expansion of monthly tax payments from 1 July 2027, and what that refers to is pay-as-you-go instalments, being able to pay those, opt in to pay those monthly, and also the potential for a I guess a live calculator that the ATO is happy for one to rely on using accounting data. Again, not much in the way of detail on that, but potentially something to sort of aid the cash flow around tax instalment payments. The business register uplift and director ID integrations is really about getting government departments to talk and sort of streamline data flows. And there's a Globe Pillar 2 side-by-side package implementation, which I don't have many clients in that space, so I did reach out to Elizabeth Jules, who's one of our specialists. Broadly, from her perspective, there's no surprise here. It sort of helps with some of the reporting that particularly the larger corporates need to do. They do apply from 1 January 2026, and really the primary impact is on US headquartered groups. So any further questions, I'd suggest reach out to Elizabeth Jules directly, and she'll be more than happy to chat through that. In terms of other changes, there is the 100% FBT EV exemption, which is currently in place. That's been confirmed that will reduce to a 25% permanent discount by 2029 in a staged manner. Now, my understanding is that the existing arrangements in place will continue with that 100% until they sort of close out. There's also money in the budget for state tax harmonisation. I sort of read that as payroll tax, which for businesses that operate across multiple states, that's always appreciated to try and sort of simplify the burden on that front. And the large proprietary definition thresholds are set to double for revenue and assets. No sort of confirmation on whether it increases for employee numbers or not. And there's no start date on this. So this is, again, probably sort of simplifies things for particularly businesses, companies that are on the cusp of the current large proprietary definitions. But in saying that, there is definitely value to having an annual audit completed, doing proper financials, applying accounting standards and the like. So hopefully that just gives a little bit of breathing space for businesses to sort of get things in order. The government has confirmed they're continuing their ban on foreign investors purchasing existing homes and extending that to mid-2029. So key takeaways. I think I've sort of had to reflect on, and reflecting on the last 30 odd hours, because that is how, I guess, old these announcements are. There's a lot to unpack and digest, particularly due to the far-reaching tax reforms. Negative gearing, capital gains tax and trust distribution tax are all sort of been announced, and they all have flow-on impacts, potentially unintended, but also intended. Ultimately, the devil will be in the detail. And I think for a lot of my clients, it's about, let's wait and see. I appreciate there's a lot of discussion on social media, there's a lot of news articles and the like, but we're effectively in this policy vacuum where we know what the old rules are, but we're not necessarily aware of what the new rules will exactly look like and whether they will actually sort of come to fruition. I do anticipate the maths on after-tax investment returns and structures will look quite different, but it's just a question of how much different. So I think the question that I've had from a number of my clients in particular is, where does this leave us structuring-wise? And I guess that then lends itself to what am I advising my clients? So I think we're pausing. We're sort of understanding these measures in a little bit more detail with the fullness of time, and the ability to see the far-reaching impacts of them. I think for anything that's an existing structure, it probably makes sense to hold and see where things land. Is there a rollover that could be applied? Is there an ability just to simplify the structure off the back of these changes? Or perhaps do we just accept the new world order? I think corporate beneficiaries will be the new unknown. What happens in that space? Are the numbers that have been on these slides true? Is that the intended consequence? And one sort of the thing that popped into my mind is if a corporate beneficiary, as example, receives solely a fully franked dividend from a trust distribution, how do these rules interact? Like, do the rules still apply, or have we kind of ticked the boxes and therefore that's sort of still okay? I think the hard one, and I've got a number of live matters at the moment, is new structures, current transactions, and the like. And that one's quite difficult because we've got a position where we know what a structure that works sort of based on the current rules is, but we also sort of have these new rules, and therefore we've got this vacuum of having to make choices based on sort of effectively two sets of rules, a bit of unknown, and the like. So I think there's obviously a lot to unpack there. Hopefully we've sort of been able to run you through the changes, given you some practical considerations, and I do expect that apart from the simplest of taxpayers, I expect there'll be significant conversations across reviewing capital gains tax positions and how they impact succession plans, estate planning, reassessing existing structures, modelling those outcomes and assessing costs, revisiting property investment strategies, keeping in mind new properties receive the 50% capital gains discount and negative gearing. But also, I think by and large, there's going to be increased compliance, increased advisor fees, and a minimum tax outcomes that the government's looking for. So hopefully that's been helpful. And with that, I will hand over to our Chief Investment Officer, Cameron Curko, to chat through the economics of the budget.
Right. Thanks, Ankit. If we can just move over one slide. I'm going to keep it like reasonably high level, but what we're going to be discussing here today is a mix of the budget implications for both the broader economy and investments as well, like given our focus here, and then touch on sort of where Australia and the global economy stands right now. So if we go to the next slide. So in terms of key economic announcements, so housing reform was obviously a big feature here in terms of the changes to both negative gearing and CGT. In terms of the specific impact on housing, that's arguably a bit more negligible. So we had the $2 billion announced for the local infrastructure fund, which is designed to really help facilitate the rollout of like new housing estates, new apartment blocks and like by helping states and local governments fund the necessary infrastructure. But if you actually summarize all these announcements down in terms of the actual housing impact, in terms of net new supply that we're going to see over the next decade, it's only an estimated 35,000 homes that are going to be created. So roughly a few thousand a year, which in the grand scheme of things is small, but the hope there is obviously by effectively tackling the investor class that will create more owner-occupiers within housing. Now, in terms of other key announcements, structural spending's going to get bigger. While we did see some modest tax relief in terms of the lift to the lowest tax rate threshold, what we're seeing in terms of healthcare, in terms of defence and the like, we're going to see meaningful growth in structural factors of spending. We saw the hospital deal for $25 billion over the next decade announced as just one example, and a further $53 billion announced for the defence sector. more broadly speaking, the CGT reforms could have some pretty significant implications for both investment and capital allocation or capital formation decisions. So that's also going to be an area to watch for our economy. Like, one of the big complaints coming into this budget was Australia has a productivity problem. And to be perfectly blunt, while we've seen some moves around the edges in terms of deregulation, easing things like payroll tax administration that Ankit pointed out, in terms of an overall sort of G up for productivity, that's not necessarily evident. The last point to note on the NDIS, there's massive savings being targeted there, almost 38 billion over the next 4 years, as well as slowing the growth meaningfully for the next decade as well. And the execution is going to potentially prove quite difficult there. Next slide. So in terms of the economic impact, look, effectively, we're expecting it to be supportive, albeit a bit less so than what we saw in 2025 in terms of a growth impact. And what that chart's showing you is really the overall net impact. So, and that's important to note because it's not just the federal government that's spending money, it's also the states. And the states often have the lion's share of the spending burden, the way our system works. And what we've seen there is like meaningful injections in both healthcare and infrastructure spending. The Victorian suburban rail loop's probably one of the more notable examples, where we just saw a further 3.8 billion in Commonwealth funding advanced to that project, which is already expected to account for almost 35 billion in terms of its total budget. And given how some of these projects go, there's potential for cost overruns there. So the things saving federal finances have been higher income tax collections and higher commodity prices. And that's what's helping constrain the size of the expected deficit going forward. If we move to the next slide. When we talk about what I was hinting at earlier, the structural deficit, what we're seeing here is expected growth in terms of total dollars over the next decade out to 2037. And really, as I mentioned before, defence and healthcare. And that last category to the far right, that's our interest expense. And that's, while it's come back a bit from the prior MyFO announcement, we're expecting to see that grow above 8% per annum over the next decade. So some meaningful drivers of like bigger deficits going forward. The NDIS to the far left is going to be the saving grace, but the execution there has been highly problematic for the government. They failed this year, for example, to hit an 8% growth target. It's expected to hit 10% for this year. So being able to materially claw back on that, the proof will be in the pudding. Next slide. And in terms of the investment implications, so Ankit already broadly covered in a lot of detail CGT. I think the high level consequences I basically want to say is this is a material net negative for anything where capital growth is a key part of it, whether that's international shares, private assets, gold, cryptocurrencies, and like. For any of those assets, this is a sort of worst scenario to be expected. And more broadly speaking, for the economy, I think there's a meaningful case to be made in terms of what it does for capital formation, particularly for startups. Like, a big part of startups' advantage against incumbents is being able to offer employees equity with the hope that by taking this risk, it'll be worth something sometime down the track. And what the return to an indexation method does is arguably it's a flawed approach because it doesn't really reflect the risk being taken, particularly by entrepreneurs. And the other point to note as well is this is a sort of far more administratively complex scenario to be tangling with. Like, you all just listen to what Ankit was discussing. It's meaningfully more difficult, not just for financial advisors, there's going to be greater demand for tax accountants, tax agents, and the like, just to administer what this system is going to look like over the coming years. Next slide. So turning to the global economic outlook, and really what I wanted to touch on here, like all of you will be aware to some extent, Middle East is really important for oil and natural gas, which are used for automotive vehicles and energy production. They're also quite important for plastic production, fertilizers, and even things that you might not have considered, such as base metals, aluminium, copper. The fact that the Middle East is effectively closed to ship in right now is seen a meaningful trickling through of inflation, in some cases surging across the world. We just saw copper prices, for example, at record highs, and which has really seen BHP and Rio share price in the last week surge drastically. And the thing to take away from this as well is we really have a case globally of haves versus have-nots. So richer countries such as ourselves can afford to pay for the supply of commodities that we need. Other countries, particularly in Asia, which are relying on oil imports, such as Indonesia, India, the Philippines, you're already starting to see signs of demand destruction underway, and these countries' economies are under some meaningful pressure. And that's only starting to mount. Each day, the straits remain closed. If we go to the next slide. Do we have a finishing line? I think this is a big question. So, well, for those of us here, like, okay, an obvious example of how we might have felt the pain from this for everyone attending is just when you're refilling your car. And with the fuel excise cut, the impact of that as well as has been less. But another factor that's helped when it comes to gasoline prices has been the drawdown of global oil inventories. And what this chart is showing is estimates from JP Morgan analysts trying to get a sense of how long before those inventories start to become drastically depleted. And we're going to see a meaningful surge in energy prices as a result. And at current levels, September looms as a key item. And what we would say is political realities might also feature more heavily. US important midterm elections are coming up in November this year. So hopefully we should see some action in terms of a resolution, some kind of more meaningful peace deal that can allow the strait to open. Otherwise, the sort of negative scenarios where you start to see not just what we call like a slowing of growth, but recession starts to become a more live risk. If we move on. Okay. And what this chart just translates to, we're starting to see that trickle through of inflation come through. China, for example, has been caught in a deflationary quagmire over the last few years post-COVID, and even they've started to see inflation emerge. The sustainability of this is going to really depend on how long the straits are closed. On the positive front, we don't expect to see a repeat of what we saw in the 1970s because the global economy is fundamentally different and less reliant on oil in an overall sense. We will probably start to see some more meaningful pressure on central banks to raise rates to counteract. We've seen that here with the RBA, and others might well have to follow suit in the months ahead. If we turn to the next slide. The follow-on for that is, what does it mean for global growth? And there we see a much more mixed backdrop. The US as a net energy exporter is a bit better insulated than most to deal with this saga. And they've also benefited from sort of sizable fiscal, I guess, from both President Trump as well as President Biden's programs preceding him. In China, their efforts to become more economically resilient have also shielded them in relative speaking terms. Europe, on the other hand, is flirting with sort of near recessionary conditions, and the latest economic data suggests we might actually see a contraction there in the June quarter. So we see likely prospects of a global slowdown as of yet, we're not seeing like realistic prospects of a global recession. The damage is being done, but it's not drastic enough to make that a likely scenario. So if we go next slide. And turn into the Australian economy, what we're seeing there is, look, slowdown in growth is underway, and we've already seen some signs of it in consumer credit data from both Westpac and Macquarie. Broadly speaking, we started in this period from a relatively good place versus international peers, but we do have signs where growth has sort of persisted at below trend levels, where we're really struggling to sort of generate higher amounts of output from our labour and capital resources. And we could turn, for example, to focus more on growth via population, but a lot of those big overarching questions for the Australian economy still aren't answered and by this budget or by policymakers. So really the near-term scenario is still positive growth, but more of a muddle through weaker period in the years ahead. If we go to the next slide. And lastly, just to touch on inflation, we're expecting across consensus and the like a meaningful slowdown, but that's going to be very contingent on what happens in the Middle East. The budget measures compared to prior years are offering far less near-term assistance to households. So that could have meaningful consequences on the growth side as we see a bit of a substitution effect being made because they aren't being supported anywhere near as much at neither state nor federal level. We're not seeing, for example, the electricity subsidies we saw last year. And the forecast we're seeing depicted here is highly fragile in our view, and there is definitely a risk that the RBA may need to move further. Next slide. And to wrap it up, what I want to say is this is a significant budget, but its real impact, economically speaking, continuation of this structural growth spending, so meaningfully higher targets over time that the government's really trying to sort of rein some of that in with the NDIS savings, but the execution there is going to be problematic in our view. Broadly speaking, global backdrop, the Iran conflict, you can't shy away from it. It is a significant feature. The headlines today are focusing on Trump's visit to China. While that's all well and good, it's the Middle East that should really be the focus, and until that gets resolved, we're going to have some of these flow-on problems continue to persist. While we were positioned in a reasonably good state heading into this, we are at the front of it, and we are starting to see some of those impacts trickle through, and we may, in fact, see the RBA position to move hawkishly further, depending how the inflation numbers pan out. So now I'll hand it back over to Jake to coordinate Q&A.
Fantastic. Thanks very much, Cameron and Ankit. Now, we have had some questions coming through. Just a reminder to everyone, feel free to pop some more questions into the chat or the Q&A section, and we'll try to address them. Now, Ankit, a lot of these questions are in the details, so I think we'll just have to do the best that we can. The first question is about FBT salary sacrificing, I assume for electric vehicles. And just trying to work out whether we have before 1st of April 2027 to continue to utilise the existing rules.
That is my understanding, yes.
Yep.
So I think when you look at the FBT provisions, particularly around EVs, it's a stepped approach, but also looks at when particular leases and the like were actually entered into.
Okay.
Yep.
The next question is an interesting one about the death of pre-CGT assets, which I must admit was one of those ones that seemed to sneak in. I didn't see it in any of the leaks that came out previously. It just popped in.
Yep.
And the question is essentially how that works. So if there was a pre-CGT asset acquired before 85, does the budget expose them to retrospective taxation? How will it work?
So I must admit, I didn't deep dive into this because similar to Jake, it was probably a little bit of a sleeper provision that came through. My understanding is that there's an ability to get a valuation for that particular asset, which is, depending on the asset, might be easier said than done in some cases. And then it's that market value on the 1st of July 27 that forms the cost base of that particular investment. And therefore, it's really only should be gains from that point onwards that are taxed under the indexation. I would particularly sort of caution, I think there's going to be quite a bit of work around the pre-1985 sort of assets because they don't necessarily always sit, say, in individual names or the like. And we still need to wait and see what those rules look like when the legislation comes out. But that's definitely one of the announcements to bring those into the capital gains tax net.
Okay, and I think, an interesting thing to that, and also the changes to the CGT discount, I expect valuers are going to be very, very busy around 1 July 2027.
Yep, I wonder if maybe Pitchers needs to invest in a valuation firm.
We do have not property valuations, but business valuations.
Yes, definitely.
The next question is really about the mechanism of the minimum 30% tax on trust distributions and specifically about dividends. So if dividends are distributed via discretionary trust to adult children on minimal income, will they get a refund in relation to the franking credit? How, do we have any clarity on how that'll work?
Yep. My understanding is that it's a franking credit at the trust level. That franking credit's applied against the minimum 30% tax, and it effectively converts that from a refundable franking credit in the beneficiary's name to a non-refundable tax offset. Is the way that I've sort of interpreted the rules. Again, it's sort of hard to know until we actually see the detail whether that's kind of what the plan is.
Okay. We have a question just about the timing of the negative gearing and the CGT rules. So do we have any clarity on, so I think actually this is a new build apartment question, but it might be interesting to get your view on both.
Yep.
Where you've got straddle of contract date, so you've exchanged contracts, but you have not yet settled until after budget night. Do we have any clarity on how that'll work?
I believe there is a specific exclusion where exchanges happened, but settlement hasn't occurred. But offhand, I don't recall whether that's for negative gearing, capital. I expect that would be only for negative gearing, because capital gains tax. But I think that we need to confirm that. I'm not sure offhand.
And I think there's an interesting question from Stephen Henderson, which we probably again won't know the answer to. But what defines a new house? And I think that's a cracker question. Because substantial renovations, is that going to get us there? How do you what complexities might arise from that?
Again, I haven't sort of deep dived into that particular definitional bit, but my understanding is the housing supply needs to increase. So one of the examples from recollection is where you've got existing home, you knock that down, you build sort of a duplex. That's considered adding to housing supply. But again, these are all the nuances, I think, as advisors, as we're working through this with client scenarios, we're sort of coming across these sort of questions, and we don't necessarily have all the answers as we stand.
Okay. And another interesting question, which again, we may not know the answer to, but it's about if you have existing residential property and you borrow against that property after today, or after yesterday, after the budget came out,
Tuesday night.
Whether we have any view on gearing implications for that.
I haven't seen anything in that space. I guess just be mindful that even though there's a lot to this budget, there's still a plethora of other legislation and pronouncements out there. And I think on new borrowings, you ultimately look at the current rules as they stand and be mindful of it's not, I guess, what the borrowings are secured against, it's what they're utilised for. So going back to some of those core principles that underpin the tax rules.
And it seems to me, Ankit, that this whole budget is really a war on trusts. The government seemed to have gone against it with this minimum tax and also the kind of neutering of CGT. And you kind of touched on this briefly, but do you think trusts are still attractive asset holding vehicles? And if you don't think they are, what other vehicles would you recommend? Kind of where do people sit now?
Yeah, and I think I've sort of started to form a view. I don't think I've completely formed that yet, but I think what it's sort of pushing us towards is whether maybe it is company structures are the sort of the preferred vehicle for investment go forward. But then the bit that I sort of stumble on is who owns the shares in that company. Is it an individual? Is it a discretionary trust? Because I think the government's sort of coming at discretionary trusts saying they're bad, they give you tax flexibility, therefore using lower tax rates. But a lot of families use it for the asset protection where you've got, say, a law partner, they're exposed because they're part of a partnership, therefore you set up a trust and you sort of have the asset protection bits there. It can be used in an estate planning context as well. So I think the bit that will unfold is trusts still probably have a place, but will they be the preferred vehicle or, if you like, the default vehicle for investment go forward? Maybe not. And maybe it is that you're moving more towards the utilisation of corporates for the investment piece rather than, say, discretionary trust. And I think the bit that sort of hangs off that as well is I think superannuation and asset allocations across different entities may shift as well. So super at the moment, as per Minnie's comments, really hasn't been touched, but does that sort of become as example, the growth asset vehicle or what it does? I think it just changes the nature of the conversations. So I think that there's a whole bunch of those sort of things. But then one of the hasn't been spoken about, that what about the business owners? Like there's not much in the budget about SMEs and business owners and those that don't get capital gains discount, but are then subject to these higher rates of indexation and taxation on capital gains where the business was their nest egg and that was going to sort of be how they're going to retire. So I think there's a bit of planning in that space, but we're now starting to see a little bit more and more sort of thought bubbles on these permutations and what structures may look like going forward under these new rules. I reckon the last 30 hours has just been spent on trying to digest what the rules are. And the next sort of couple of weeks will be really sort of looking at specific client scenarios, going, what does a playbook and sort of the structuring look like in the future? What are the pros and cons? And then once legislation's in place, then hopefully we've got a little bit more of an idea of how we might be able to change structures that are in place at the moment. So yes, a significant space to be watched.
Fantastic. Thank you very much. Well, I think that brings us to a close. So on behalf of Ankit, Cameron and myself, we'd like to thank all of our attendees for coming along and joining the discussion. We hope that you found this information helpful. As mentioned earlier, our contact details along with a recording will be sent out within 3 business days. So please feel free to reach out to us directly. If today's webinar has presented questions for you and your circumstances, hopefully it's triggered a lot of thoughts. So feel free to send some questions through. Thank you very much, everyone, and have a great afternoon.